The Mariner S. Eccles Federal Reserve Board building is shown. The very large building located in Washington, D.C. is constructed of white marble and has a grand entranceway. Exhibit 15. 1. Credit. The Fed U.S. government works. Learning outcomes. After reading this chapter, you should be able to answer these questions. What is money? What are its characteristics and functions? And what are the three parts of the U.S. money supply? How does the Federal Reserve manage the money supply? What are the key financial institutions, and what role do they play in the process of financial intermediation? How does the Federal Deposit Insurance Corporation, FDIC, protect depositors' funds? What roles do U.S. banks play in the international marketplace? What trends are reshaping financial institutions? Exploring business careers. Michelle Moore, Bank of America. Technology continues to change every facet of daily life, including how consumers interact with banks and other financial institutions. Whether large or small, banks have to stay one step ahead of the competition when it comes to providing top-notch service to their customers, including digital and mobile channels. Michelle Moore, head of digital banking at Bank of America, has worked in various parts of the company for more than 14 years. Regardless of her role within the organization, Moore has consistently demonstrated her obsession with exceptional service and how best to make sure the bank is providing customers with products and features that will make their lives easier, keep them loyal to the organization, and ultimately increase sales. The photograph shows a Bank of America ATM inside a large kiosk in a parking lot. Exhibit 15-2. Michelle Moore is the head of digital banking at Bank of America. Credit, Mike Mozart /Flickr /Attribution 2. Generic CC by 20. While overseeing the bank's call center operations, Moore was asked to take on the bank's mobile initiatives, a request that befuddled her. Moore is the first to tell you she is no techie. She admits she kept her beloved flip phone too long before opting for a smartphone. Yet her people skills and her drive to provide the best customer service made her the perfect person to take on the bank's digital and mobile efforts. Like other major financial institutions, Bank of America did not have a stellar reputation when it came to digital or mobile banking. Although customers used the bank's digital offerings, the services were basic, even as the smartphone revolution changed many of life's daily activities. Once Moore and her digital team got the bank's mobile app up to speed, they began to figure out how to make it better. The team started to add features to the app, making sure that nearly everything customers can do at a bank branch they can do on the new and improved app. In addition, Moore and her group created a digital assistant feature that uses artificial intelligence and predictive analytics to provide customers with the same level of advice and expertise that previously would have been reserved for customers with high-end wealth management accounts. A play on the word America, the app called Erica recently debuted to the public, and customer reaction has been positive, but Moore is never satisfied with the status quo. She encourages her team to constantly ask how customers will use the app and what will it take to make and keep them happy with the digital assistance features. For example, after Moore read an article on the success of Apple's Siri and Amazon's Alexa, she wondered, why can't our banking app talk to clients? She pushed her team to add a voice feature to Erica, which gives the digital assistant a competitive edge over other banking mobile apps for now. Moore knows that customer sentiment is critical to the bank's success, especially in mobile banking. She continues to be obsessed by customer reviews and how the bank can increase customer satisfaction quickly and efficiently, and she knows that agility is critical in an ever-changing bank environment. Her efforts are paying off. Several years ago, Bank of America had 6 million mobile banking users. Today, that number has jumped to more than 22 million. In a recent 3-month period, mobile banking customers logged into their accounts more than 967 million times, more than double the number of desktop logins. And when customers need to visit a local bank branch, more and more of them are booking appointments via the mobile app each week. Although she knows there is more work to do, Moore's common-sense approach to listening to customers while leveraging technology will help Bank of America increase sales and stay ahead of the competition. Sources: Robert Barba, Digital Banker of the Year, B of A's Michelle Moore, American Banker, https://www.americanbanker.com, May 31, 2017. Robert Barba, Mom, Marathoner, App Maker, B of A's Michelle Moore, American Banker, https://www.americanbanker.com. Com, May 31, 2017. IOB AUAD and James Toplin, Bank of America boosts digital banking segment. Business Insider, http://www.businessinsider.com, April 19, 2017. Michelle Moore, leading the way in digital banking, The Financial Brand, https, thefinancialbrand.com, February 20, 2017. Hillary Burns, Michelle Moore on the latest for BOF-A's digital operations, Charlotte Business Journal, https://www.bizjournals.com, December 21, 2016. Advanced technology, globalization of markets, and the relaxation of regulatory restrictions continue to accelerate the pace of change in the financial services industry. These changes are giving businesses and consumers new options for conducting their financial transactions. The competitive landscape for financial institutions is also changing, creating new ways for these firms to increase their market share and boost profits. This chapter focuses on the role of financial institutions in U.S. and international economies. It discusses different types of financial institutions, how they are set up and how they function internally, and government oversight of their operations. Because financial institutions connect people with money, this chapter begins with a discussion of money, its characteristics and functions, and the components of the U.S. money supply. Next, it explains the role of the Federal Reserve System in managing the money supply. Then it describes different types of financial institutions and their services and the organizations that ensure customer deposits. The chapter ends with a discussion of international banking and trends in financial institutions. What is money, what are its characteristics and functions, and what are the three parts of the U.S. money supply? Money is anything that is acceptable as payment for goods and services. It affects our lives in many ways. We earn it, spend it, save it, invest it, and often wish we had more of it. Businesses and government use money in similar ways. Both require money to finance their operations. By controlling the amount of money in circulation, the federal government can promote economic growth and stability. For this reason, money has been called the lubricant of the machinery that drives our economic system. Our banking system was developed to ease the handling of money. Characteristics of money. For money to be a suitable means of exchange, it should have these key characteristics. Scarcity. Money should be scarce enough to have some value but not so scarce as to be unavailable. Pebbles, which meet some of the other criteria, would not work well as money because they are widely available. Too much money in circulation increases prices and inflation. Governments control the scarcity of money by limiting the quantity of money in circulation. Durability. Any item used as money must be durable. A perishable item such as a banana becomes useless as money when it spoils. Even early societies used durable forms of money, such as metal coins and paper money, which lasted for a long time. Portability. Money must be easily moved around. Large or bulky items, such as boulders or heavy gold bars, cannot be transported easily from place to place. Divisibility. Money must be capable of being divided into smaller parts. Divisible forms of money help make transactions of all sizes and amounts possible. Table 15. 1 provides some interesting facts about our money. Functions of money. Using a variety of items, as money would be confusing. Thus, societies develop a uniform money system to measure the value of goods and services. For money to be acceptable, it must function as a medium of exchange, as a standard of value, and as a store of value. As a medium of exchange, money makes transactions easier. Having a common form of payment is much less complicated than having a barter system, wherein goods and services are exchanged for other goods and services. Money allows the exchange of products to be a simple process. Money also serves as a standard of value. With a form of money whose value is accepted by all, goods and services can be priced in standard units. This makes it easy to measure the value of products and allows transactions to be recorded in consistent terms. As a store of value, money is used to hold wealth. It retains its value over time, although it may lose some of its purchasing power due to inflation. Individuals may choose to keep their money for future use rather than exchange it today for other types of products or assets. Fun facts about U.S. currency. Did you know? Currency paper is composed of 25% linen and 75% cotton. About 4,000 double folds, first forward and then backwards, are required before a note will tear. As of mid-July 2017, there was more than $56 trillion in U.S. currency in circulation, with $40 billion in coins. 95% of the notes printed each year are used to replace notes already in circulation. The largest note ever printed by the Bureau of Engraving and Printing was the $100,000 gold certificate, Series 1934. During fiscal year 2017, it cost approximately 4 cents per note to produce nearly 40 billion U.S. paper currency notes. A stack of currency 1 mile high would contain over 14 million notes. If you had 10 billion $1 notes and spent one every second of every day, it would require 317 years for you to go broke. Table 15. One source: Bureau of Engraving and Printing. Resources: https://www.manufactory.gov. Access September 7, 2017. The U.S. money supply. The U.S. money supply is composed of currency, demand deposits, and time deposits. Currency is cash held in the form of coins and paper money. Other forms of currency include traveler's checks, cashier's checks, and money orders. The amount of currency in circulation depends on public demand. Domestic demand is influenced primarily by prices for goods and services, income levels, and the availability of alternative payment methods such as credit cards. Until the mid-1980s, nearly all U.S. currency circulated only domestically. Today, domestic circulation totals only a small fraction of the total amount of U.S. currency in circulation. Over the past decade, the amount of U.S. currency has doubled to more than $56 trillion and is held both inside and outside the country. Foreign demand is influenced by the political and economic uncertainties associated with some foreign currencies, and recent estimates suggest that between 1/2 and 2/3 of the value of currency in circulation is held abroad. Some residents of foreign countries hold dollars as a store of value, whereas others use it as a medium of exchange. Federal Reserve notes make up more than 99% of all U.S. currency in circulation. Each year, the Federal Reserve Board determines new currency demand and submits a print order to the Treasury's Bureau of Engraving and Printing, BEP. The order represents the Federal Reserve System's estimate of the amount of currency the public will need in the upcoming year and reflects estimated changes in currency usage and destruction rates of unfit currency. Table 15.2 shows how long we can expect our money to last on average. How long will your money last? Have you ever wondered how quickly money wears out from being handled or damaged? Not surprisingly, smaller denominations have a shorter lifespan. $1 bill 8 years. $5 bill 5 years. $10 bill 5 years. $20 bill 9 years. $50 bill 5 years. $100 bill 0 years. Table 15.2 source: How long is the lifespan of U.S. paper money? https://www.federalreserve.gov. Access September 7, 2017. Demand deposits consist of money kept in checking accounts that can be withdrawn by depositors on demand. Demand deposits include regular checking accounts as well as interest-bearing and other special types of checking accounts. Time deposits are deposits at a bank or other financial institution that pay interest but cannot be withdrawn on demand. Examples are certain savings accounts, money market deposit accounts, and certificates of deposit. Economists use two terms to report on and discuss trends in the U.S. monetary system: M1 and M2. M1, the M stands for money, is used to describe the total amount of readily available money in the system and includes currency and demand deposits. As of August 2017, the M1 monetary supply was $3.5 trillion. M2 includes all M1 monies plus time deposits and other money that is not immediately accessible. In August 2017, the M2 monetary supply was $13.6 trillion. $2 credit cards, sometimes referred to as plastic money, are routinely used as a substitute for cash and checks. Credit cards are not money, they are a form of borrowing. When a bank issues a credit card to a consumer, it gives a short-term loan to the consumer by directly paying the seller for the consumer's purchases. The consumer pays the credit card company after receiving the monthly statement. Credit cards do not replace money, they simply defer payment. Concept check. What is money and what are its characteristics? What are the main functions of money? What are the three main components of the U.S. money supply? How do they relate to M1 and M2? How does the Federal Reserve manage the money supply? Before the 20th century, there was very little government regulation of the U.S. financial or monetary systems. In 1907, however, several large banks failed, creating a public panic that led worried depositors to withdraw their money from other banks. Soon many other banks had failed and the U.S. banking system was near collapse. The Panic of 1907 was so severe that Congress created the Federal Reserve System in 1913 to provide the nation with a more stable monetary and banking system. The Federal Reserve System, commonly called the Fed, is the central bank of the United States. The Fed's primary mission is to oversee the nation's monetary and credit system and to support the ongoing operation of America's private banking system. The Fed's actions affect the interest rates banks charge businesses and consumers, help keep inflation under control, and ultimately stabilize the U.S. financial system. The Fed operates as an independent government entity. It derives its authority from Congress, but its decisions do not have to be approved by the President, Congress, or any other government branch. However, Congress does periodically review the Fed's activities, and the Fed must work within the economic framework established by the government. The Fed consists of 12 district banks, each covering a specific geographic area. Exhibit 15.3 shows the 12 districts of the Federal Reserve. Each district has its own bank president who oversees operations within that district. Originally, the Federal Reserve System was created to control the money supply, act as a borrowing source for banks, hold the deposits of member banks, and supervise banking practices. Its activities have since broadened, making it the most powerful financial institution in the United States. Today, 4 of the Federal Reserve System's most important responsibilities are carrying out monetary policy, setting rules on credit, distributing currency, and making check clearing easier. The map is sectioned into 12 districts, and one city within each district is noted. District 1 is the New England states, and the city noted is Boston. District 2 is New York State, and the city noted is New York City. District 3 is made up of New Jersey and the eastern half of Pennsylvania, and the city noted is Philadelphia. District 4 is made up of Ohio, the northeastern portion of Kentucky, and the western portion of Pennsylvania. The city noted is Cleveland. District 5 is made up of Virginia, West Virginia, North and South Carolina, Delaware, Maryland, and Washington, D.C. The city noted for District 5 is Richmond. District 6 is made up of the eastern half of Tennessee, Georgia, Florida, Alabama, the southern half of Mississippi, and the southern half of Louisiana. The city noted in District 6 is Atlanta. District 7 is made up of the southern half of Michigan, the northern half of Indiana, the northern half of Illinois, and Iowa. The city noted for District 7 is Chicago. District 8 is made up of Missouri, much of Kentucky, Arkansas, and the northern portion of Mississippi. The city noted in District 8 is St. Louis. District 9 is made up of Montana, North and South Dakota, Minnesota, Wisconsin, and the northern portion of Michigan. The city noted in District 9 is Minneapolis. District 10 is made up of Wyoming, Colorado, Nebraska, Kansas, Oklahoma, and the very northern portion of New Mexico. The city noted in District 10 is Kansas City. District 11 contains Texas, the northern portion of Louisiana, and the remaining portion of New Mexico. The city noted in District 11 is Dallas. District 12 is made up of Washington State, Oregon, Idaho, Utah, Nevada, Arizona, California, Hawaii, and Alaska. The city noted for District 12 is San Francisco. Exhibit 15.3 Federal Reserve Districts and Banks Source: Federal Reserve Banks, https://www. Richmond Fed. Org. Access September 7, 2017. Carrying out monetary policy. The most important function of the Federal Reserve System is carrying out monetary policy. The Federal Open Market Committee, FOMC, is the Fed policymaking body that meets 8 times a year to make monetary policy decisions. It uses its power to change the money supply in order to control inflation and interest rates, increase employment, and influence economic activity. 3 tools used by the Federal Reserve System in managing the money supply are open market operations, reserve requirements, and the discount rate. Table 15. 3 summarizes the short-term effects of these tools on the economy. Open market operations, the tool most frequently used by the Federal Reserve, involve the purchase or sale of U.S. government bonds. The U.S. Treasury issues bonds to obtain the extra money needed to run the government if taxes and other revenues aren't enough. In effect, Treasury bonds are long-term loans, 5 years or longer, made by businesses and individuals to the government. The Federal Reserve buys and sells these bonds for the Treasury. When the Federal Reserve buys bonds, it puts money into the economy. Banks have more money to lend, so they reduce interest rates, which generally stimulates economic activity. The opposite occurs when the Federal Reserve sells government bonds. The Federal Reserve System's monetary tools and their effects. Tool action: effect on money supply, effect on interest rates, effect on economic activity. Open market operations: buy government bonds, increases, lowers, stimulates. Sell government bonds, decreases, raises, slows down. Reserve requirements: raise reserve requirements, decreases, raises, slows down. Lower reserve requirements: increases, lowers, stimulates. Discount rate: raise discount rate, decreases, raises, slows down. Lower discount rate: increases, lowers, stimulates. Table 15. 3. Banks that are members of the Federal Reserve System must hold some of their deposits in cash in their vaults or in an account at a district bank. This reserve requirement ranges from 3 to 10% on different types of deposits. When the Federal Reserve raises the reserve requirement, banks must hold larger reserves and thus have less money to lend. As a result, interest rates rise and economic activity slows down. Lowering the reserve requirement increases loanable funds, causes banks to lower interest rates, and stimulates the economy. However, the Federal Reserve seldom changes reserve requirements. The Federal Reserve is called the banker's bank because it lends money to banks that need it. The interest rate that the Federal Reserve charges its member banks is called the discount rate. When the discount rate is less than the cost of other sources of funds, such as certificates of deposit, commercial banks borrow from the Federal Reserve and then lend the funds at a higher rate to customers. The banks profit from the spread or difference between the rate they charge their customers and the rate paid to the Federal Reserve. Changes in the discount rate usually produce changes in the interest rate that banks charge their customers. The Federal Reserve raises the discount rate to slow down economic growth and lowers it to stimulate growth. Setting rules on credit. Another activity of the Federal Reserve System is setting rules on credit. It controls the credit terms on some loans made by banks and other lending institutions. This power, called selective credit controls, includes consumer credit rules and margin requirements. Consumer credit rules establish the minimum down payments and maximum repayment periods for consumer loans. The Federal Reserve uses credit rules to slow or stimulate consumer credit purchases. Margin requirements specify the minimum amount of cash an investor must put up to buy securities or investment certificates issued by corporations or governments. The balance of the purchase cost can be financed through borrowing from a bank or brokerage firm. By lowering the margin requirement, the Federal Reserve stimulates securities trading. Raising the margin requirement slows trading. Distributing currency, keeping the cash flowing. The Federal Reserve distributes the coins minted and the paper money printed by the U.S. Treasury to banks. Most paper money is in the form of Federal Reserve notes. Look at a dollar bill and you'll see Federal Reserve Note at the top. The large letter seal on the left indicates which Federal Reserve Bank issued it. For example, bills bearing a D seal are issued by the Federal Reserve Bank of Cleveland, and those with an L seal. What are the key financial institutions and what role do they play in the process of financial intermediation? The well-developed financial system in the United States supports our high standard of living. The system allows those who wish to borrow money to do so with relative ease. It also gives savers a variety of ways to earn interest on their savings. For example, a computer company that wants to build a new headquarters in Atlanta might be financed partly with the savings of families in California. The Californians deposit their money in a local financial institution. That institution looks for a profitable and safe way to use the money and decides to make a real estate loan to the computer company. The transfer of funds from savers to investors enables businesses to expand and the economy to grow. Households are important participants in the U.S. financial system. Although many households borrow money to finance purchases, they supply funds to the financial system through their purchases and savings. Overall, businesses and governments are users of funds. They borrow more money than they save. Sometimes those who have funds deal directly with those who want them. A wealthy realtor, for example, may lend money to a client to buy a house. Most often, financial institutions act as intermediaries or go-betweens between the suppliers and demanders of funds. The institutions accept savers' deposits and invest them in financial products, such as loans that are expected to produce a return. This process, called financial intermediation, is shown in Exhibit 15. 5. Households are shown as suppliers of funds and businesses and governments are shown as demanders. However, a single household, business, or government can be either a supplier or a demander, depending on the circumstances. Financial institutions are the heart of the financial system. They are convenient vehicles for financial intermediation. They can be divided into two broad groups. Depository institutions, those that accept deposits, and non-depository institutions, those that do not accept deposits. The center of the diagram is labeled financial intermediaries. On each side of the center there are illustrations. On the left there are demanders of funds, and on the right there are suppliers of funds. Under financial intermediaries, it reads as follows. Commercial banks, savings and loan associations, savings banks, credit unions, life insurance companies, and pension funds. Arrows point back and forth from here to the demander of funds, and the arrow is labeled as loans, securities. Demanders of funds are noted as business, governments. Arrows point back and forth from the financial intermediaries and suppliers of funds. The arrow is labeled bank accounts, life insurance, and retirement income. Supplier of funds are noted as households. Exhibit 15. 5. The financial intermediation process, only the dominant suppliers and demanders are shown here. Clearly, a single household, business, or government can be either a supplier or demander, depending on circumstances. Attribution: Copyright Rice University OpenStax under CC by 40 license. Depository financial institutions. Not all depository financial institutions are alike. Most people call the place where they save their money a bank. Some of those places are indeed banks, but other depository institutions include thrift institutions and credit unions. Commercial banks. A commercial bank is a profit-oriented financial institution that accepts deposits, makes business and consumer loans, invests in government and corporate securities, and provides other financial services. Commercial banks vary greatly in size, from the money center banks located in the nation's financial centers to smaller regional and local community banks. As a result of consolidations, small banks are decreasing in number. A large share of the nation's banking business is now held by a relatively small number of big banks. There are approximately 5,011 commercial banks in the United States, accounting for nearly $16 trillion in assets and $9 trillion in total liabilities. 10 banks hold a variety of assets, as shown in the diagram in Exhibit 15. 6. Table 15. 4 lists the top 10 insured U.S. chartered commercial banks based on their consolidated assets. A pie chart is shown. The sections and percentages are as follows. Total cash 11%, federal funds 3%, other assets 10%, securities 21%, loans and leases 55%, Exhibit 15. 6. Assets of FDIC-insured commercial banks, 2017 source, FDIC, Statistics on Depository Institutions Report for Commercial Banks as of 6/30/17, https://www.5fdic.gov accessed September 7, 2017. Customers' deposits are a commercial bank's major source of funds, the main use for which is loans. The difference between the interest the bank earns on loans and the interest it pays on deposits, plus fees it earns from other financial services, pays the bank's costs and provides a profit. Commercial banks are corporations owned and operated by individuals or other corporations. They can be either national or state banks, and to do business they must get a bank charter, an operating license from a state or federal government. National banks are chartered by the Comptroller of the Currency, who is part of the U.S. Treasury Department. These banks must belong to the Federal Reserve System and must carry insurance on their deposits from the Federal Deposit Insurance Corporation. State banks are chartered by the state in which they are based. Generally, state banks are smaller than national banks, are less closely regulated than national banks, and are not required to belong to the Federal Reserve System. Thrift institutions. A thrift institution is a depository institution formed specifically to encourage household saving and to make home mortgage loans. Thrift institutions include savings and loan associations, S and LS, and savings banks. S and LS keep large percentages of their assets in home mortgages. Compared with S and LS, savings banks focus less on mortgage loans and more on stock and bond investments. Thrifts are declining in number. At their peak in the late 1960s, there were more than 4,800. But a combination of factors, including sharp increases in interest rates in the late 1970s and increased loan defaults during the recession of the early 1980s, has reduced their ranks significantly. By year-end 2016, due mostly to acquisitions by or conversions to commercial banks or other savings banks, the number of thrifts had fallen to fewer than 800. 11. Top 10 insured U.S. chartered commercial banks based on consolidated assets, 2016. Bank consolidated assets. 1 J.P. Morgan Chase & Co. 2,082,803,000. 2 Wells Fargo & Co. 1,727,235,000. 3 Bank of America Corp. 1,677,490,000. 4 Citigroup 1,349,581,000. 5 U.S. Bancorp 441,010,000. 6 PNC Financial Services Group 356,000,000. 7 Capital One Financial Corp. 286,080,000. 8 TD Bank North America 269,031,000. 9 Bank of New York Mellon Corp. 257,576,000. 10 State Street Bank and Trust Corp. 239,203,000. Table 15 for source. Insured U.S. chartered commercial banks that have consolidated assets of $300 million or more as of 12/31/16, https://www. Federal Reserve. Gov. Access September 7, 2017. Customer satisfaction and quality. Rating banks, mobile and branch banking a must. Which banks provide the best customer satisfaction? JD Power JDP, based in Costa Mesa, California, ranked 136 major banks in 11 U.S. regions based on responses from more than 78,000 retail banking customers. In the research company's 2017 U.S. Retail Banking Satisfaction Study, top performers received high ratings in account information, channel activities such as branch, mobile, website, and ATM, fees, problem resolution, and product offerings. While specific banks took the top spots in various areas of the country, the overall customer sentiment in the JDP survey was clear. Consumers want banks that offer both digital experience and personal interaction in local branches, and the ones that can make these two channels work together effortlessly will be the most successful, especially among millennials. Findings also suggest banks that provide a user-friendly digital experience will attract and retain customers, and this digital experience must work seamlessly with a local branch system, as younger customers avail themselves of other banking services such as mortgages and wealth management in the future. Other key survey findings include, regardless of age group, more customers than ever are using mobile banking. More than 70% of all customers visited a local branch an average of 14 times over the past year, and their overall satisfaction was 27 index points higher than those who did not visit a bank branch. Close to 65% of bank customers have mobile payment services linked to their accounts. Successful problem resolution is a key driver of customer satisfaction, and younger customers prefer to resolve issues online or via social media. Assessing customer satisfaction is also the goal of the American Customer Satisfaction Index, ACSI, which granted Citibank the top spot in the national bank category in its most recent survey, with a 12% jump in its overall score. Other top super-regional banks in the ACSI study include BB&T, Fifth Third Bank, Capital One, and Citizens Bank. Overall, national banks improved their overall customer experience the most, up more than 6% from ACSI's previous survey. Sources: Digital Branch Drive-Through or ATM. Yes, please. Say bank customers in JD Power Study. http://www.jdpower.com. Access September 11, 2017. ACSI Customer Satisfaction with Banks Insurance Rebounds. http://www.thixi.org. Access September 11, 2017. American Bankers Association Millennials and Banking. https://www.aba.com. Access September 11, 2017. Tanya Gazdik Citibank Leads National Banks in Study. https://www.mediapost.com. November 15, 2016. Critical Thinking Questions. What can banks and financial institutions do to retain their customers and make them feel valued? Is there a cost involved in not making customer service a priority? Explain your answer. Credit unions. A credit union is a not-for-profit, member-owned financial cooperative. Credit union members typically have something in common. They may, for example, work for the same employer, belong to the same union or professional group, or attend the same church or school. The credit union pools their assets or savings in order to make loans and offer other services to members. The not-for-profit status of credit unions makes them tax-exempt, so they can pay good interest rates on deposits and offer loans at favorable interest rates. Like banks, credit unions can have either a state or federal charter. The approximately 5,700 credit unions in the United States have more than 108 million members and over $1.34 trillion in assets. The 5 largest credit unions in the United States are shown in Table 15. 5. Although the U.S. credit union system remained strong during the 2007-2009 financial crisis, consumer-owned credit unions in several regions weakened as a result of home foreclosures, business failures, and unemployment rates. Today, the credit union system continues to demonstrate its resilience as the economy continues to rebound. 12. Services offered. Commercial banks, thrift institutions, and credit unions offer a wide range of financial services for businesses and consumers. Typical services offered by depository financial institutions are listed in Table 15. 6. Some financial institutions specialize in providing financial services to a particular type of customer, such as consumer banking services or business banking services. Managing change. Banks take on P2P payments. Person-to-person P2P payment systems are big business, and U.S. banks are now working together to compete in this billion-dollar industry. P2P transfers made through mobile apps such as Venmo, PayPal, Square Cash, and others accounted for more than $147 billion in digital payments in 2016, according to recent research by the 8 Group. The simplicity of P2P apps has made them a part of everyday life for millions, especially millennials and young adults who use their smartphones for many daily activities. Venmo, for example, requires merely a phone number and email in order for someone to transfer money to a friend, and the friend creates a Venmo account to receive payment. Social media sites also encourage their members to transfer money via mobile apps such as Google Wallet and Facebook Messenger. Banks have been successful allowing their own customers to transfer money via apps. However, P2P transfers have been limited to other customers of the same bank until now. A consortium of more than 30 banks recently introduced a mobile app called Zelle, which can be used by anyone to transfer funds to customers across these banking institutions. A downside of using Venmo is that it may take a day or two for money to arrive in a recipient's account because the money flows through an intermediary. With Zelle, the transfer of money between 2 accounts will occur instantaneously, making payments happen quickly. For now, most banks using Zelle are making the service free of charge, knowing that it is in their best interest to migrate people to a cashless and checkless environment, which will eventually lower their costs in terms of services, labor, overhead, etc. Is a cashless society imminent now that major banks have gotten on board with P2P payments? Probably not, but the banking industry's commitment to challenging Venmo and other digital payment systems eventually may result in a stronger revenue stream and underscores their business strategy of staying connected to customers of all ages. Critical thinking questions. Does working together on a P2P system help banks stay competitive? Explain your reasoning. Do you think P2P payment systems will eventually eliminate the use of cash in our society? Why or why not? Sources: use Venmo with anyone. HTTPS Venmo. Co-accessed September 12, 2017. Sarah Perez, Zelle, the U.S. Bank's Venmo rival will launch its mobile app next week. TechCrunch. HTTPS TechCrunch.com September 8, 2017. Kevin Wack, Zelle says 4M users have enrolled since June launch. American Banker. HTTPS//www.americanbanker.com September 8, 2017. Jennifer Surin, Venmo killer, banks roll out faster P2P payments with Zelle. Bloomberg Technology. HTTPS//www.bloomberg.com June 12, 2017. James Rufus Corin, as millennials Venmo each other money, banks fight back with their own mobile apps. Los Angeles Times. HTTP//www.latimes.com March 27, 2017. 5 largest U.S. credit unions. Navy Federal Credit Union, Vienna, Virginia. State Employees Credit Union, Raleigh, North Carolina. Pentagon Federal Credit Union, Alexandria, Virginia. Boeing Employees Credit Union, Tukwila, Washington. School First Federal Credit Union, Santa Ana, California. Table 15. 5 Source Top 100 Credit Unions. HTTP//www.usercreditunions.com Access September 7, 2017. Non-depository financial institutions. Some financial institutions provide certain banking services but do not accept deposits. These non-depository financial institutions include insurance companies, pension funds, brokerage firms, and finance companies. They serve both individuals and businesses. Insurance companies. Insurance companies are major suppliers of funds. Policyholders make payments, called premiums, to buy financial protection from the insurance company. Insurance companies invest the premiums in stocks, bonds, real estate, business loans, and real estate loans for large projects. A photograph shows a large tree that has fallen over onto a parked car. Exhibit 15. 7 insurance companies, hurt by billions of dollars in unforeseen payouts during natural disasters such as Hurricane Irma in 2017, are rethinking their reliance on catastrophe risk modelers, whose risk estimates failed to anticipate cataclysmic storms such as Hurricanes Katrina, Irma, and Harvey. Cat-risk businesses forecast potential weather-related expenses for insurers through sophisticated computer modeling that analyzes historical meteorological data. How do frequent natural disasters affect insurance companies and their policyholders? Credit, Kyobo/Flickr/attribution 2 generic CC by 2. 0. Services offered by depository financial institutions. Service description. Savings accounts pay interest on deposits. Checking accounts allow depositors to withdraw any amount of funds at any time up to the amount on deposit. Money market deposit accounts savings accounts on which the interest rate is set at market rates. Certificates of deposit (CD) pay a higher interest rate than regular savings accounts, provided that the deposit remains for a specified period. Consumer loans to individuals to finance the purchase of a home, car, or other expensive items. Business loans to businesses and other organizations to finance their operations. Electronic funds transfer use of computers and mobile devices to conduct financial transactions. Automated teller machine (ATM) allows bank customers to make deposits, withdrawals, and transfers from their accounts 24 hours a day. Debit cards allow customers to transfer money from their bank account directly to a merchant's account to pay for purchases. Online banking allows customers to conduct financial transactions via the internet or through a dial-in line that operates with a bank's software. Mobile apps technology that allows consumers to download programs to mobile devices that enable them to take care of banking, financial and other transactions. Direct deposit of paychecks enabled through employers and payroll service vendors. Allows financial institutions to accept direct deposits of payroll checks to consumers' checking and/or savings accounts on a regular basis. Table 15. 6. Pension funds. Corporations, unions, and governments set aside large pools of money for later use in paying retirement benefits to their employees or members. These pension funds are managed by the employers or unions themselves or by outside managers, such as life insurance firms, commercial banks, and private investment firms. Pension plan members receive a specified monthly payment when they reach a given age. After setting aside enough money to pay near-term benefits, pension funds invest the rest in business loans, stocks, bonds, or real estate. They often invest large sums in the stock of the employer. U.S. pension fund assets total nearly $3.4 trillion. 13. Brokerage firms. A brokerage firm buys and sells securities, stocks, and bonds for its clients and gives them related advice. Many brokerage firms offer some banking services. They may offer clients a combined checking and savings account with a high interest rate and also make loans backed by securities to them. Finance companies. A finance company makes short-term loans for which the borrower puts up tangible assets such as an automobile, inventory, machinery, or property as security. Finance companies often make loans to individuals or businesses that cannot get credit elsewhere, promising new businesses with no track record, and firms that can't get more credit from a bank often obtain loans from commercial finance companies. Consumer finance companies make loans to individuals, often to cover the lease or purchase of large consumer goods such as automobiles or major household appliances. To compensate for the extra risk, finance companies usually charge higher interest rates than banks. Concept check. What is the financial intermediation process? Differentiate between the three types of depository financial institutions and the services they offer. What are the four main types of non-depository financial institutions? How does the Federal Deposit Insurance Corporation, FDIC, protect depositors' funds, the U.S. banking system worked fairly well from when the Federal Reserve System was established in 1913 until the stock market crash of 1929 and the Great Depression that followed. Business failures caused by these events resulted in major cash shortages as people rushed to withdraw their money from banks. Many cash-starved banks failed because the Federal Reserve did not, as expected, lend money to them. The government's efforts to prevent bank failures were ineffective. Over the next 2 years, 5,000 banks, about 20% of the total number, failed. President Franklin D. Roosevelt made strengthening the banking system his first priority. After taking office in 1933, Roosevelt declared a bank holiday, closing all banks for a week so he could take corrective action. Congress passed the Banking Act of 1933, which empowered the Federal Reserve System to regulate banks and reform the banking system. The Act's most important provision was the creation of the Federal Deposit Insurance Corporation, FDIC, to insure deposits in commercial banks. The 1933 Act also gave the Federal Reserve authority to set reserve requirements, ban interest on demand deposits, regulate the interest rates on time deposits, and prohibit banks from investing in specified types of securities. In 1934, the Federal Savings and Loan Insurance Corporation, FSLIC, was formed to insure deposits at S and LS. When the FSLIC went bankrupt in the 1980s, the FDIC took over responsibility for administering the fund that insures deposits at thrift institutions. Today, the major deposit insurance funds include the following: the Deposit Insurance Fund, DIF, administered by the FDIC. This fund provides deposit insurance to commercial banks and thrift institutions. The National Credit Union Share Insurance Fund, administered by the National Credit Union Administration. This fund provides deposit insurance to credit unions. Role of the FDIC. The FDIC is an independent, quasi-public corporation backed by the full faith and credit of the U.S. government. It examines and supervises about 4,000 banks and savings banks, more than half the institutions in the banking system. It insures trillions of dollars of deposits in U.S. banks and thrift institutions against loss if the financial institution fails. 14. The FDIC insures all member banks in the Federal Reserve System. The ceiling on insured deposits is $250,000 per account. Each insured bank pays the insurance premiums, which are a fixed percentage of the bank's domestic deposits. In 1993, the FDIC switched from a flat rate for deposit insurance to a risk-based premium system because of the large number of bank and thrift failures during the 1980s and early 1990s. Some experts argue that certain banks take too much risk because they view deposit insurance as a safety net for their depositors, a view many believe contributed to earlier bank failures. Enforcement by the FDIC. To ensure that banks operate fairly and profitably, the FDIC sets guidelines for banks and then reviews the financial records and management practices of member banks at least once a year. Bank examiners perform these reviews during unannounced visits, rating banks on their compliance with banking regulations. For example, the Equal Credit Opportunity Act, which states that a bank cannot refuse to lend money to people because of their color, religion, or national origin. Examiners also rate a bank's overall financial condition, focusing on loan quality, management practices, earnings, liquidity, and whether the bank has enough capital equity to safely support its activities. When bank examiners conclude that a bank has serious financial problems, the FDIC can take several actions. It can lend money to the bank, recommend that the bank merge with a stronger bank, require the bank to use new management practices or replace its managers, buy loans from the bank, or provide extra equity capital to the bank. The FDIC may even cover all deposits at a troubled bank, including those over $250,000, to restore the public's confidence in the financial system. With the fallout from the financial crisis of 2007-2009 still having an effect on banking and financial markets in this country and abroad, the FDIC works closely with the Federal Reserve to make sure that banks continue to maintain healthy balance sheets by testing their solvency on a regular basis. Although the future of Dodd-Frank regulations is open to speculation in 2017, the consequences of thinking that banks and other financial institutions were too big to fail has had a positive impact on banking and financial transactions, with the hope that such a financial crisis can be avoided in the future. Concept check. What is the FDIC and what are its responsibilities? What are the major deposit insurance funds? What can the FDIC do to help financially troubled banks? What roles do U.S. banks play in the international marketplace? The financial marketplace spans the globe, with money routinely flowing across international borders. U.S. banks play an important role in global business by providing loans to foreign governments and businesses. Multinational corporations need many special banking services, such as foreign currency exchange and funding for overseas investments. U.S. banks also offer trade-related services such as global cash management that help firms manage their cash flows, improve their payment efficiency, and reduce their exposure to operational risks. Sometimes consumers in other nations have a need for banking services that banks in their own countries don't provide. Therefore, large banks often look beyond their national borders for profitable banking opportunities. Many U.S. banks have expanded into overseas markets by opening offices in Europe, Latin America, and Asia. They often provide better customer service than local banks and have access to more sources of funding. Citibank, for example, was the first bank to offer banking by phone and 24-hour-a-day ATM service in Japan. For U.S. banks, expanding internationally can be difficult. Banks in other nations are often subject to fewer regulations than U.S. banks, making it easier for them to undercut American banks on the pricing of loans and services. Some governments also protect their banks against foreign competition. For example, the Chinese government imposes high fees and limits the amount of deposits that foreign banks can accept from customers. It also controls foreign bank deposit and loan interest rates, limiting the ability of foreign banks to compete with government-owned Chinese banks. Despite the banking restrictions for foreign banks in China, many of the large U.S. banking institutions continue to do business there. 15. International banks operating within the United States also have a substantial impact on the economy through job creation. They employ thousands of people in the United States, and most workers are U.S. citizens operating in capital expenditures, taxes, and other contributions. According to March 2017 Federal Reserve data, the combined banking and non-banking assets of the U.S. operations of foreign banks total more than $24 trillion, $16. The world's biggest banks 2017. Industrial and Commercial Bank of China. China Construction Bank. J.P. Morgan Chase & Co. USA. Wells Fargo & Co. USA. Agricultural Bank of China. Bank of America Corp. USA. Bank of China Limited, Citigroup USA. BNP Paribas France. Mitsubishi UFJ Financial Group, Japan. Table 15. 7 Source: The world's biggest banks in 2017. The American bull market strengthens. Forbes. http://www.forbes.com May 24, 2017. The United States has 4 banks listed in the top 10 world's biggest banks, as shown in Table 15. 7. Political and economic uncertainty in other countries can make international banking a high-risk venture. European and Asian banks were not immune to the financial crisis of 2007-2009. In fact, several countries, including Greece, Portugal, Spain, and Ireland, continue to rebound slowly from the near collapse of their economic and financial systems they experienced a decade ago. Financial bailouts spearheaded by the European Union and the International Monetary Fund have helped stabilize the European and global economy. It is unclear at this writing, however, whether the impending Brexit move by the United Kingdom, leaving the European Union, will impact international banking, as many of the world's top financial institutions seek to move their global operations out of London and shift them to other financial capitals within the Eurozone. 17. Concept check. What is the role of U.S. banks in international banking? What challenges do U.S. banks face in foreign markets? What trends are reshaping financial institutions? What factors will influence financial institutions in the coming years? The latest reports suggest there will be a continued focus on regulatory and compliance issues, especially after the recent financial crisis, as well as on operational efficiency and technological advances. Banks will continue to tackle customer engagement and technology initiatives over the next few years, according to a report by 8 Group, a Boston-based firm that forecasts U.S. banking trends. Technology continues to empower consumers to control their banking and commerce experiences. Financial institutions have become better at using data and data analytics to help them better understand their customers' needs and behaviors, which may provide them the competitive advantage they seek in the retail banking industry. 18. Financial technology or fintech services will continue to disrupt the banking industry and provide opportunities for banks and other institutions to work closely with fintech companies that can help them innovate and streamline their business practices. According to recent research by Goldman Sachs, fintech startups have the potential to take away billions of dollars in business from traditional investment and lending institutions. Some of the services offered by fintech firms include payment transaction processing, mobile and web payment services for e-commerce firms, peer-to-peer lending, and integrated financial software programs. 19. Mobile financial apps will continue to be a strategic advantage that separates traditional banking approaches from innovative companies that can offer their clients a connected digital experience when it comes to their money and investments. Consumers will expect personalization of bank products and services as part of their routine interaction with financial institutions. Otherwise, they will look elsewhere for a competitive platform to meet all of their financial and banking needs. 20. Although most banks continue to offer local branch offices, the next few years will see branch banking become less prevalent as online and mobile services become more popular. Most banking institutions already offer apps that allow customers to move money between accounts or deposit a check via their smartphones, which happens almost instantaneously, rather than get in a car, drive to the bank, and deposit the check in person. In addition, online payment platforms such as PayPal, Apple Pay, Google Wallet, Shopify, Stripe, and others continue to make personal and business transactions seamless. In this 24/7 world, consumers expect their banking and financial transactions to happen quickly and efficiently. 21. The photo shows a point-of-sales machine at a store. The screen on the machine reads Google Wallet, and a person is holding their phone above the flat base next to the screen. Exhibit 15. 8 online payment platforms such as Google Wallet, Apple Pay, and others continue to make personal and business transactions seamless and efficient. How can companies continue to leverage technology to make financial transactions as easy as a swipe or tap on a mobile device? Credit: Sergio Uceta/Flickr/attribution 2 generic CC by 2. 0. Managing change. Chatbots help banks connect with customers. Computer software using artificial intelligence (AI) to simulate conversation with humans. Chatbots have become an integral part of the banking industry's push to connect with customers while keeping operations and costs in line. They can be an effective tool in what banks call conversational commerce, interacting with customers via messaging and digital platforms. Typically, banks engage their customers through various channels, including human channels, in-person transactions or service calls with a live agent, and digital channels, websites, mobile apps, email, and online ads. Although customers may have a favorite way to interact with their bank, these channels can cost banks a substantial amount of money, and financial institutions are constantly looking for ways to reduce costs while maintaining quality customer service. It is not surprising that in-person transactions are the most expensive service provided by banks. However, not every transaction with a customer requires human intervention. As technology continues to evolve, more banks have figured out they can leverage their services to fit the everyday activities of their tech-savvy customers by using chatbots as the next step in customer service. For example, as mentioned in the opening feature in this module, Bank of America recently introduced Erica, a voice and text-enabled chatbot that helps customers make smarter banking decisions. Erica sends customers notifications, points out areas where they can save money, updates credit ratings, and can help facilitate bill payments within the bank's mobile app. Capital One, another player in the U.S. banking industry, launched Eno, a text-enabled chatbot that helps customers manage their money via smartphone. Customers can ask Eno questions about account balances, credit history, recent transactions, payment history, etc. Via text messaging. Eno is the second virtual assistant created by Capital One. It already launched its own Amazon Alexa feature, which allows customers to ask about checking account balances and when upcoming bills are due and pay credit card bills in conversations with Alexa. AI chatbots provide benefits to both banks and customers. Banks are using them to streamline operations, automate customer support, and provide a convenient and positive customer experience. Customers rely on this type of digital assistant to make their lives easier and keep them current on personal and business transactions without having to wait on hold for a person to respond to questions that can easily be answered by chatbots. A recent report by Gartner, an IT research firm, estimates that by the year 2020, consumers will manage 85% of their banking relationships via chatbots, saving customers time and banks millions of dollars. With more than 1.2 billion users of mobile banking worldwide, chatbots can be an effective tool to help banks become more efficient, more proactive in anticipating customer needs, and more sensitive to their bottom line. Critical thinking questions. Do you think chatbots will eventually replace customer service representatives at U.S. banks? Explain your reasoning. What are some advantages and disadvantages of using a digital assistant as part of your banking routine? Sources: UA Kathy Chang and Cindy Thompson, Chatbots in Banking, Silicon Valley Data Science, https, svds.com, Access September 11, 2017. Maruti Tech Labs Banking Chatbots, https, Chatbot Magazine.com, Access September 11, 2017. Number of mobile payment users from 2009 to 2016 by region in millions, Statista, https://www.statista.com, Access September 11, 2017. Blake Morgan, 5 Ways Chatbots Can Improve Customer Experience in Banking, Forbes, http://www.forbes.com, August 6, 2017. Elizabeth Mills, How 10 Big Banks Are Using Chatbots to Boost Their Business, https://www.abe.ai, March 13, 2017. Concept check. How will fintech services enhance the overall banking experience? What challenges do banks face when it comes to offering local branch services to customers?